Okay, so let's unpack this. We all kind of rely on IRAs, individual retirement arrangements, but most of us probably treat them like a simple product wrapper.
Yeah, like the thing you just open at the bank or brokerage, right? Without really thinking about what's under the hood.
Exactly. And what few people realize is that this really common financial tool is actually governed by this massive, incredibly detailed piece of federal law.
Oh, yeah. 26 U.S. Code, Section 408. That statute is pretty much the operational manual for every single IRA in the country.
Huh. So if you've ever been confused by the specific rules for contributions or like rollovers or withdrawals,
Because those rules are mandated, often down to the penny and the exact deadline, right there in the legal code itself.
so our mission today is to get past the glossy financial brochure summary.
Go straight to the source.
We're going straight to the source to understand the precise legal mechanics, the really rigid constraints, but also some surprising flexibilities that govern IRAs.
And also their small business cousins, right? SEPs and Simples?
Exactly.
Yeah.
This deep dive is really for you, the learner, who wants to know why the government gives these accounts special tax status, what the actual rules are.
Well, to really get the rules, we have to start at the absolute beginning.
Mhm.
What is an IRA legally defined as? The law actually separates them into two primary types.
Okay, the first one, I think this is the one most people know, is the individual retirement account. That's like the brokerage account, right? The trust holding stocks and funds.
Exactly. Subsection A defines that type of trust, and it mandates some incredibly specific details. Like, for instance, except when you're doing a rollover.
Yeah.
The account legally must accept all contributions only in cash.
Only cash. Wow. So that immediately stops you from, say, transferring shares of stock you already own directly into the account as a contribution.
Precisely. You'd have to sell the stock first, get the cash, and then put the cash in. It's a very deliberate restriction on how assets can flow in.
Okay. What else?
Another really critical legal restriction, probably designed to preserve the account's purpose, is that no part of the trust funds can ever be invested in life insurance contracts.
Ah, okay. So Congress wants these to be pure savings vehicles, not sort of tangled up with insurance or estate planning tools.
That seems to be the idea. And for your protection as the owner, the account interest has to be what the law calls non-forfeitable.
Non-forfeitable.
Yeah.
Why is that wording so critical? Like, what were they trying to prevent there?
Well, it's really legal speak for it's yours right away and nobody can take it back based on some condition.
Okay.
It means the balance can't be subject to, weird forfeiture clauses or conditions. It locks in your ownership immediately, gives you that security for long-term planning.
Makes sense. There's also this anti-commingling rule. It sounds super technical.
It does sound technical, but the practical effect is pretty simple.
Okay.
The law basically says IRA assets cannot be mixed with your other personal property. This keeps the IRA structure legally pure.
So the tax-deferred money doesn't get confused with your regular taxable stuff.
Exactly. The only big exception is if those assets are held in what they call common trust funds or common investment funds.
Which is how mutual funds work inside IRAs.
Precisely. That's the legal mechanism that allows it.
Okay, so that's the trust account. What's the second type? The annuity?
Right. The individual retirement annuity. This isn't a trust holding assets. It's actually an annuity contract issued by an insurance company.
And I bet the rules are just as specific.
Oh, absolutely. The law requires, for example, that the contract must be non-transferable by the owner. You can't just sell your IRA annuity contract to someone else.
Okay.
And interestingly, Congress wrote the rules to stop these from becoming like fixed cost savings plans. They specifically say the premiums cannot be fixed.
Huh. Why do you think they got so detailed, even down to rules about premium refunds?
Yeah.
What were they worried about?
It really seems to be about preventing any kind of cash leakage from the tax-deferred structure. The law specifically says any premium refund has to be used for future premiums or benefits before the end of the next calendar year.
So you can't just get a refund check and treat it like a little tax-free cash withdrawal.
Exactly. Every little detail in this statute seems designed to reinforce the idea of the IRA as a vehicle only for retirement savings.
Okay, so once we understand the basic IRA vehicle itself, trust or annuity, the next step in the law seems to be how employers can use these for small businesses. SEPs and Simples.
Right. SEPs, simplified employee pensions, they're essentially just standard IRAs, but they meet some extra requirements for employer contributions.
And the law focuses heavily on who has to be included, right? Participation and non-discrimination.
Very heavily. The rules are really designed to stop employers from leaving people out.
So what are the minimums? Who does an employer have to contribute for?
Okay, so an employer has to contribute to the SEP IRA for every single employee who is 1, age 21 or older, 2, has worked for the company in at least 3 of the last 5 years, and 3, got paid at least $450 in compensation for the year.
$450? That sounds incredibly low.
It is low, and that floor amount gets adjusted for inflation over time, but the low number really shows the intent. They wanted to make sure even part-time or seasonal staff got included.
Right. Stop employers from just giving benefits to the full-time, higher-paid folks.
Precisely. And to keep it fair, the non-discrimination rule is super rigid. Employer contributions have to bear a uniform relationship to each employee's pay.
Meaning the percentage has to be the same for everyone.
Basically, yes. They can't give, say, 10% to the boss and 2% to everyone else. It has to be uniform, though they only count compensation up to a certain limit, around $200,000 currently, which also gets adjusted.
And a really big protection for employees and SAPs is the immediate vesting, right?
Huge. The law mandates that employer contributions cannot be conditioned on the employees staying with the company.
And the employer can't stop them from taking the money out if they leave.
Correct. The employer cannot prohibit withdrawals. It's the employee's money immediately, which is a critical difference from many traditional pension or even 401k plans where vesting might take several years.
Okay, so that's SFPs. Now, simple IRAs. These seem even more focused on the really small businesses.
They are. The eligibility gateway here is pretty straightforward. Congress basically used employer size.
How small do you have to be?
To be an eligible employer, the rule says you must have had no more than 100 employees who received at least $5,000 in compensation during the preceding year.
So they look back a year to see if you qualify.
Exactly. It's Congress trying to draw a line and say, okay, these smallest businesses get this specific, simpler plan option. And there's even a little wiggle room, a 2-year grace period, if they happen to go over the 100-employee limit later.
And structurally, the simple plan usually has to be the only retirement plan the employer offers. To keep it simple, I guess.
That's generally the rule, yes.
Yeah.
Keeps things streamlined. And the contribution structure is also quite defined.
How does that work? Is it just employer money?
No, it starts with the employee. It's based on a salary reduction arrangement, meaning employees can choose to defer some of their own pay, but then the employer must contribute too.
Okay. Oh.
They have 2 choices, basically. Either they make a matching contribution, usually dollar for dollar, up to 3% of the employee's pay,
Okay.
or they can choose to make a non-elective contribution of 2% of compensation for all eligible employees, even those who didn't contribute themselves, as long as they earned at least $5,000.
So there's a guaranteed employer contribution floor in there for the employee's retirement savings.
Yeah.
Non-negotiable.
Exactly. And just like SFPs, all contributions in a simple IRA are immediately non-forfeitable, fully vested.
All right. So we've covered how the accounts are defined, how money goes in, including these employer plans. Now, the big one, getting the money out, distributions.
Yeah.
What's the default legal consequence when money leaves an IRA?
Well, the general rule, which you find in subsection D, is pretty simple on its face. Any amount distributed is generally included in your gross income and taxed in that year.
Because the money went in pre-tax, or the earnings grew tax-deferred, so the tax is due when it comes out.
Right. The law essentially says the basis in the contract or account is 0 for tax purposes. So the distribution is basically income you deferred maybe decades ago.
But the huge exception, the one people use all the time, is the rollover. And this is where the legal details get really critical.
Oh, absolutely. Precision is key here. To avoid immediate taxation, the entire amount you take out has to be paid into another eligible retirement plan, like another IRA or maybe a 401k, within 60 days of when you receive it.
The 60-day clock. Very famous.
Very famous and very strict.
Yeah.
But here's a crucial restriction that trips people up. You can only use that 60-day indirect rollover, where the money actually comes out to you first, once within a 1-year period across all your IRAs.
Okay. So that stops people from basically using their IRAs like a short-term interest-free loan fund. Take money out, put it back 59 days later, do it again 3 months later.
Exactly. Congress saw that potential for abuse and shut it down by limiting the frequency of those indirect rollovers, 1 per year per person.
Important distinction. But what if something goes wrong? Life happens. Does the law allow any flexibility on that 60-day deadline?
It does, thankfully. There's a crucial relief valve built in. The Secretary of the Treasury has the authority to waive the 60-day requirement in cases where it would be unfair not to, like due to equity or good conscience.
Does it give examples?
Yes, it specifically mentions things like casualty or disaster. So, if your house burns down right when you were supposed to complete the rollover, there's a mechanism to ask for relief. It acknowledges life isn't always neat.
That's good to know. Now, another really critical distinction comes with inherited IRAs, right?
Yeah.
If you inherit an IRA from someone who wasn't your spouse.
Yes, that's a major fork in the road, legally speaking. The rules are different. Generally, rollovers are explicitly denied for inherited IRAs unless the person inheriting is the surviving spouse.
So a non-spouse inheritor, like a child, can't just roll that inherited IRA money into their own existing IRA.
Correct. They have to keep it in the inherited IRA structure and follow specific distribution rules, which often involve taking money out faster than the spouse might have to.
Okay. The law has also evolved, hasn't it, to allow some new ways to take money out tax-free under very specific circumstances. These sound like big planning opportunities.
They really are. The Qualified Charitable Distribution, or QCD, is probably the best known example now.
Right, for older individuals.
Yes. If you're age 70 and a half or older, and that age is tied pretty closely to when required minimum distributions, or RMDs, used to start for everyone, you can exclude up to $100,000 per year from your gross income.
Wow, exclude $100K K of income. How?
Provided the distribution is made directly from your IRA trustee to a qualified public charity.
Ah, the direct transfer is key. Can't take the cash yourself and then write a check.
Nope, has to be trustee to charity to get that tax-free treatment. It keeps the chain of custody clean legally. And that $100K limit, by the way, is now indexed for inflation after 2023.
And there's even a weird little side rule for certain types of trusts.
Yeah, a very specific one-time election where you can send up to $50,000, also adjusted now, to certain split interest entities like charitable remainder trusts or gift annuities. Highly specialized planning.
That really shows how the code gets amended over time, maybe due to lobbying for specific charitable planning techniques.
Absolutely. It's constantly evolving. Another flexible distribution allows for HSA funding a health savings account.
Oh, interesting. You can move money from an IRA to an HSA.
Yes, but with limitations. It's a one-time only direct trustee-to-trustee transfer allowed from a traditional or Roth IRA, but specifically not from an ongoing SEP or simple IRA to fund your HSA.
One time only. And I bet there's a catch.
There's a big one, a compliance requirement. After you do the transfer, you have to remain eligible for an HSA, meaning you must keep high-deductible health plan coverage for a full 12-month testing period immediately following the transfer.
And if you don't, if you drop the health plan after, say, 6 months,
then the amount transferred becomes taxable income, and you might owe an additional penalty. Again, the law builds in these compliance checks to stop people from just grabbing tax-free cash and then immediately changing their circumstances.
Okay, makes sense. Finally, let's get into the danger zone, the pitfalls and prohibitions. This is where things can go really wrong, really fast.
This is where you can lose all those great tax benefits we just talked about instantly.
So what's the absolute fastest way to get your IRA, nuked by the IRS?
Good way to put it. Engaging in a prohibited transaction. This usually involves specific forms of self-dealing.
Like what? Give me an example.
Like, say, using your IRA funds to buy a piece of property and then renting it out to yourself or your family member at a below-market rate. Or borrowing money from the IRA personally.
Okay, that sounds bad. What happens if you do that?
The statute lays out a brutal punishment. The entire account ceases to be an IRA, ceases to be tax-exempt, as of the first day of the taxable year in which the prohibited transaction occurred.
Whoa, back to the start of the year.
Back to the start of the year. And the entire fair market value of the account on that first day is treated as if it were distributed to you, meaning it's all taxable income right now. It's the legal nuclear option, essentially.
That is incredibly severe. It's not just a penalty on the transaction amount. It blows up the whole account's tax status retroactively.
Exactly. And related to borrowing, just using your IRA as collateral is also a big no-no.
How does that work?
Well, if you borrow money against an individual retirement annuity contract, the law says the whole contract just stops being an IRA immediately. Taxable event.
And for an IRA account?
If you use the account, or even just a portion of it, as security for a loan like pledging it to the bank, the law treats the specific portion you pledged as an immediate taxable distribution.
So, bottom line, Don't try to leverage your tax-deferred retirement money for personal loans.
Absolutely not. Congress is very clear on that.
Okay, the last big prohibition, and this one always gets some surprising reactions, is the collectible trap.
Ah, yes, the collectibles rule. Investing your IRA assets in something the law defines as a collectible is treated as a distribution,
A taxable distribution equal to what?
equal to the cost of that collectible item. So
Yeah.
you buy a $10,000 collectible with IRA funds, you instantly have $10,000 of taxable income.
And what is a collectible according to the tax code? I assume things like art, antiques.
Yes, the law defines collectible pretty broadly. It includes works of art, rugs or antiques, metals or gems, stamps or coins. And, wait for it,
Yeah.
alcoholic beverages.
Get out. You're telling me the actual U.S. tax code, section 408,
Yeah.
specifically lists booze alongside stamps and gems as something I can't buy with my IRA.
Dead serious. It's right there in black and white.
Yeah.
They clearly foresaw someone trying to fund their fine wine or rare whiskey collection with tax-deferred money and said, nope.
That's amazing. So my dream of an IRA-funded wine cellar is officially dead.
Legally speaking, yes, shut down before it started.
But hold on, aren't there exceptions? Especially around coins and metals. People talk about gold IRAs.
Yes, and this is where it gets very nuanced. The law specifically carves out an exception for certain types of precious metals.
Which ones?
Specific gold, silver, platinum, or palladium bullion that meets very strict minimum fineness standards. Think government-minted bars or rounds of a certain purity. Also, certain U.S. Eagle coins and some state-issued coins are explicitly allowed.
So some coins are okay, but others might be considered collectible stamps or coins and be prohibited.
Exactly. It draws a very fine line. A specific regulated bullion bar is okay. A rare numismatic coin might be a taxable collectible. A loose diamond, collectible. A bottle of Pappy Van Winkle, definitely a collectible.
Wow. Okay. So this whole deep dive into 26 U.S. Code Section 408 really confirms it, doesn't it? The IRA isn't just some simple account wrapper.
Not at all. It's a very strict legal vehicle, defined by incredibly rigid rules about what goes in, how it has to be structured while the money grows, and crucially, how it must eventually come out.
That really seemed to be the critical takeaway. We've seen again and again how the difference between, say, a tax-free transfer and a big taxable distribution often boils down to tiny details.
Absolutely. It's about adhering to timing, like that 60-day clock. It's about the method of transfer. Was it direct trustee to trustee, or did you touch the money? And it's about the precise legal definition of the asset itself. Is it allowed bullion or a forbidden collectible?
And following those strict definitions is basically the price you pay for getting that powerful tax deferral benefit over potentially decades.
That's the bargain, essentially. Follow our hyper-detailed rules and you get this significant tax advantage. Break the rules, even accidentally, and the consequences can be severe.
So what does this all mean for you listening? Well, think about the level of detail we've just scratched the surface on. The legal code covers everything from the minimum pay to include a part-timer and a SEP, all the way down to specifying which exact silver coins are okay, versus which bottle of vintage wine counts as a prohibited collectible alcoholic beverage.
It's incredibly granular.
So consider the practical effort involved just keeping this single statute updated. It's been amended dozens and dozens of times over the decades. What does this constant, almost microscopic evolution in the tax code tell us? Maybe about how difficult the government finds it to strike that balance.
What balance is that?
The balance between genuinely wanting to encourage everyone to save for retirement, while at the same time constantly trying to prevent, clever lawyers and accountants finding ways for wealthy individuals to exploit every possible loophole in the system. It's a perpetual tug-of-war written into law.